In this video, we're going to be performing a deep dive on Procter & Gamble's dividend safety. To begin, let's talk about Procter & Gamble's business model. Procter & Gamble is a consumer products conglomerate that sells its products in more than 180 countries and generates over $65 billion in annual sales. The company's core brands include Gillette, Tide, Charmin, Crest, Pampers, Febreze, Head & Shoulders, Bounty, Oral-B, and many others. Procter & Gamble trades with a current market capitalization of $228 billion. Procter & Gamble is a well-known dividend stock because of its compelling track record of dividend growth. With 62 years of consecutive dividend increases, Procter & Gamble is a member of the Dividend Aristocrats, a group of dividend stocks with more than 25 years of rising dividends. Procter & Gamble satisfies the requirement to be a dividend aristocrat more than twice over. Because of this, the company is not just a dividend aristocrat but also a dividend king, an even more exclusive group of dividend stocks with 50-plus years of consecutive dividend increases. Looking ahead, Procter & Gamble's high dividend yield combined with its tepid revenue growth has led some investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Procter & Gamble's dividend safety in the context of the company's current earnings. When Procter & Gamble reported first quarter financial results on October 19th, the company provided financial guidance for the full year of fiscal 2019. Procter & Gamble expects to generate 3% to 8% growth in adjusted earnings per share, which implies per share earnings of $4.45 at the midpoint. For context, Procter & Gamble currently pays a quarterly dividend of 71.72 cents per share, which implies a payout ratio of 64%. Using earnings, Procter & Gamble's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's current dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Procter & Gamble's current dividend payment to its free cash flow. In the first quarter of fiscal 2019, Procter & Gamble generated $3.567 billion of cash from operating activities and spent $1.080 billion on capital expenditures for free cash flow of $2.487 billion. The company distributed $1.853 billion in dividends to shareholders during the same time period, for a free cash flow dividend payout ratio of 75% during the first quarter of fiscal 2019. Looking over a longer time period, the trend is very similar. In fiscal 2018, Procter & Gamble generated $14.867 billion in operating cash flow and spent $3.717 billion on capital expenditures for free cash flow of $11.15 billion. The company distributed $7.310 billion in common share dividends during the same time period for a free cash flow dividend payout ratio of 66%. Using free cash flow, our conclusion is the same as when we use earnings to measure Procter & Gamble's dividend safety. The company's dividend appears safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Procter & Gamble's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Procter & Gamble's performance during this time period is shown below. As you can see, Procter & Gamble's earnings held up very well during the last major recession. Accordingly, we have no concerns about the company's ability to pay rising dividends moving forward. The last angle that we will use to assess Procter & Gamble's current dividend safety is by looking at the company's debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. In Procter & Gamble's most recent 10-K, the company disclosed that it held $10.423 billion of short-term debt with a weighted average interest rate of 0.7% and $20.863 billion of long-term debt with a weighted average interest rate of 2.5%. In aggregate, this implies total annual interest payments of $594.5 million and a weighted average interest rate of 1.9%. The following image shows how changes to Procter & Gamble's weighted average interest rate would impact its dividend safety as measured by free cash flow. As the image shows, Procter & Gamble's weighted average interest rate would need to rise to approximately the 15% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that Procter & Gamble's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Procter & Gamble's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.